The dollar just crossed 92 rupees. Think about that for a second. Most people see this headline and scroll past. They think, Nitin, I earn in rupees, I spend in rupees. Why should I care if the dollar is 80 rupees or 90 rupees? Here is the problem. There is an invisible tax draining your wallet every single day, and it never shows up on your bill. Your cooking oil, imported. Your phone, imported components. Your Netflix subscription, even that bill is effectively priced in dollars. In 2014, $1 was roughly 62 rupees. Today, it's 92. That is 46% drop in your purchasing power. So even if your salary went up by 20% on paper, your money is actually weaker globally than it was a decade ago. Today, we are going deep. I am going to show you exactly why this is happening, especially the weird part, where the dollar is weak globally but strong against us. And we will be discussing practical steps you can take to stop this leak in your bank account. Let's kill the politics. In India, we love to blame this government or that government. But look at the data. Data doesn't care about your political party. From 2004 to 2014, the rupee went from 45 rupees to 62 rupees. That is a drop of 37%. From 2014 to 2026, we moved from 62 to nearly 92 rupees. That's a drop of roughly 46%. Notice the pattern. Governments changed, policies changed, leaders changed, but the slide consistent. Mathematically, the Indian rupee loses about 3 to 4% of its value against the dollar every single year. It's not a bug in the system. It's a feature of developing economy like ours. Blaming politics won't save your money. Accepting this pattern will. Okay, let's get down to the kitchen table. How does this hit the common man? The economists call it imported inflation. I call it the silent thief. Number 1. Edible oil. India imports nearly 60% of its edible oil. When the dollar gets expensive, companies pay more to bring that oil in. They don't observe that loss, they pass it on to you. So when the oil prices goes up, don't just blame the shopkeeper, blame the currency. Number 2, electronics and gadgets. A phone that cost the company $150 to import in 2014 would have costed them roughly 9,300 rupees. Today, the same phone cost them 14,000 rupees to bring in. Same phone, same tech, you pay 4,500 extra just because the currency moved. This is why budget phones don't feel like budget phones anymore. Number 3, the education trap. This is the saddest one. If you were saving 20 lakh rupees for your kids' graduation in the US, bad news. That 20 lakh is now worth way less in dollars. The goalpost just moved 40% further away while you were strictly disciplined with your savings. Your savings stood still, the target moved away. Now, if you are running a business, listen closely. The old textbook logic was, when rupee falls, exports are good. But that's only half the truth. Compare us to Vietnam. Vietnam is a powerhouse because they are part of global supply chains. They import raw materials cheaply and export finished goods. In India, if you are a manufacturer, you likely import machinery, fuel, or raw materials. Sure, you get more rupees when you sell your product abroad, but you also pay way more rupees to buy the same raw material, the diesel for your generator, and the machines in your factory. So while we celebrate exports, our margins are being eaten alive by input cost. It's like running on a treadmill that keeps getting faster. Now, here is the most confusing part. You might read news headlines saying dollar is crashing, dollar is weak, and you look at the rupees and think, wait, if the dollar is crashing, why is it hitting 92 rupees against us?
Mr. President, with the current value of the dollar, do you think it's declined too much?
No, I think it's great. I mean, the value of the dollar, look at the business we're doing. No, dollar's doing great.
This is called global divergence. The dollar is losing value against the euro, the yen, or the pound. The dollar index is actually down, but against the rupee, it keeps winning. Why? Two reasons. Number 1, the inflation gap. In the US, inflation is roughly 2 to 3%. In India, we are often at 5 to 6% or higher. If our prices rise faster than theirs, our currency must become cheaper to stay competitive. Think of it as two cars. The US car is driving at 60 km per hour. The Indian car is driving at 100 km per hour. The distance between them will increase. and that distance is depreciation. Number 2, the oil addiction. India imports over 80% of its oil, and guess what currency we pay in? Dollars. Every time oil prices jitter due to wars, supply cuts, or geopolitics, we have to sell rupees to buy dollars to pay our bill. This constant selling of rupees kept us under pressure, even when the dollar is weak elsewhere. We are in a unique boat. The dollar might be struggling against Europe, but it's still the boss of the rupee. Okay, problem deep है. Now what is the solution? रोना धोना बंद करते हैं and let's be practical. How do you protect your wealth? Number 1, gold is your old friend. Indians have always been smart about this. Gold is priced in dollars globally. When rupee falls, domestic gold price rises automatically. If you had kept just 10 to 15% of your savings in gold since 2014, would have acted as a perfect shield against this currency drop. It's boring, but it works. Number 2, stop loving your savings account. Keeping too much cash in a savings account is risky. If inflation is 6% and rupee is falling 4%, then your bank giving you 6% interest? Do the math. You are effectively paying the bank to lose your money's value. Number 3, the US equity route. This is for the modern investor. Invest in the S&P 500 or Nasdaq via mutual funds. Why? Because when you own Apple or Microsoft, you own a dollar generating asset. If the stock goes up by 10% and the rupee falls by 5%, you effectively gain 15%. It's a double engine for your portfolio. Look, the RBI will do its job. The government will do its job. But you have to manage your own household economy. Don't get emotional about the falling rupee. Accept it as a fact of our economic cycle. The rupee is not going to back to 70. Plan your life for 100. If you are a student, plan for higher fees. If you are a business, hedge your currency risk. And if you are an investor, diversify beyond the rupee. Be practical, think clearly.